Now, these attacks, the headlines this morning really pressured the market, but there was also a lot of economic data out this morning. I want to bring in Piper Sandler, the managing director and senior economist, Jake Oubina. And Jake, first, I want to talk about just what we were just talking about, though. Just this, it's sort of, it's always lingering out there. It's sort of geopolitical risk has been high on the risk scale for the ever since the Russia-Ukraine invasion. From her point of view, if they take out maybe the oil, that hurts us, right, or has implications. But for the most part, are there any direct implications for our economy with what's happening there?
So I think the biggest risk is that, right, a retaliation by Israel that actually targets oil production facilities.
Right.
OPEC's been keen to push out their production increases. They did that earlier this month, pushing it out to December. So you're going into a tighter supply backdrop over the next couple of months. Yes, oil's been coming down, but you could see a pretty big reversal in that if that were to happen. And oil prices spiking, energy prices spiking in the past have been enough to tip the economy from a slowing into a recession, right? So I think that's what we have to worry about.
Now let's talk about the economy slowing. Manufacturing out today. Manufacturing ISM. Okay, so folks, this was your headline number. Came in just a little bit less than expected, but anything under 50 is contraction. In this report, there's so many things, Jake, that boggle the mind. But I have to ask you first and foremost, inventories caught my eye, in part because of this longshoreman strike today,
right,
which we know there may be some supply issues, but the sharp decline, 6.4 percentage points, it was actually growing, now it's contracting. What's going on here?
Yeah, so what's happening is, and what's interesting about that is the level of orders has been very low, and producers are actually moving orders through inventory, right? So production is still low. What's even more interesting is the customer inventory number rising to 50. Which tells you that customers are actually satiated from an inventory standpoint. Right. And so you're going to see even more weakness in orders going forward. To me, it's really been about orders. It's been about the fact that there's been oversupply in the economy. You can look across a wide swath of things. And that's feeding now back into prices. It's feeding back into production. It's feeding back into, importantly, employment, which
Let's talk about that from employment, 43.9 from 46 down 2.1. Yeah. That's a big drop. I mean, we were supposed to be in a manufacturing renaissance. Right. I don't know what's going on. It hasn't materialized with respect to employment. Employment contracting faster for 4 months now. Right. That's an ominous sign.
It matched the cycle low, right? And if you look at production in the economy since COVID, to your point, I mean, production is up 1.5% point to point since the pandemic started, right? The only things that have been real up are things that have been financed by CHIPS, IRA, all the high-tech stuff, fueling data centers, semiconductors, et cetera. That's been up. But in general, the economy's still in an industrial recession here.
Got to ask about the JOLTS report. Now, we know the headline employment job openings thing will look a little month over month, but this is what caught my eye. Yep. This quits is coming down. I mean, it's coming down huge. Private sector was, I think, 2.3 from 2.5, or 2.1 from 2.3. Right. And almost every category is coming down. Quits is a reflection of we know just a couple of years ago, everyone was, hey, the employee was the boss, and now it's changed completely.
Right, exactly. That's completely changed. And interestingly, quits is one of the best leading indicators of the labor market in general, right? It leads wage growth by about 9 months. It's telling us we're slowing down about 3% here over the course of the next 9 months. But it also leads the unemployment rate. On the private quit rate, right, the last time it was at 2.1%, 3 times since 2000, the unemployment rate had a 6 handle on it. And it leads the unemployment rate by about 3 months. I think we're heading toward 5% over the short term here.
5%?
Yeah.
Yeah. Jake, wish we had more time. I appreciate it, though.
You got it.
Thank you.